Breaking news, today is September 17th and the Bank of Canada cut its policy rate by a quarter point, bringing it down to 2.5%. This is the first cut since March, and it's a big moment. For months, the Bank of Canada has been holding steady at 2.75%, and people were starting to wonder if cuts were even coming this year. Well, now they've made their move. The big question is, what does this mean for your mortgage, the housing market, and your wallet? Now let's rewind for a second. Over the last year, the Bank of Canada has been cautious. They've raised rates aggressively through 2022 and 2023 to fight off inflation that was running wild. Then once inflation started to come down, they shifted gears and began slowly trimming rates. Since March, they've been holding that 2.75% policy rate steady, waiting for more data. But now the economy is showing some real cracks, and that's what's pushed them to act today. Just last month, Canada lost 65,000 jobs. That's a massive miss. Economists had actually been expecting job growth, 65,000, but instead, we saw the opposite. Unemployment is now climbing above 7%, which is the highest level that we've seen since 2016. That is a clear signal that the labor market is weakening and households are starting to feel pressure. At the same time, inflation has been easing, but not quite as fast as the Bank of Canada would like. Core CPI is still sitting above 3%, which is higher than the 2% target, but it has softened enough to give them a bit of breathing room. So with inflation coming down and the job market weakening, the bank finally had the cover they needed to make this quarter point cut. Now, a lot of people are asking, is this the start of a series of cuts or just a one-off move? That's where things get interesting, because today's decision isn't just about the present moment. It's about the ripple effect. How will this cut play out across variable rate mortgages versus fixed rates? How are lenders going to react? And what are the big forecasts saying about the months ahead? That's what we're going to dig into in this video. We'll look at the immediate impact on your mortgage payments, and we'll break down the different forecasts, from the optimistic takes to the more cautious ones. We'll look at why economists are so divided on what happens next. And then we'll give practical action plans, clear steps you can take right now to make sure that you're prepared no matter which way rates go. So stick with me, because today's cut might feel small, just 0.25%, but it could mark the beginning of a much bigger shift in the mortgage market. And if you're buying, renewing, or refinancing, you need to know exactly what this means for you. All right, now that we've set the stage, let's talk about what this cut actually means in real life. Because here's the thing, markets had already priced in a cut. Everyone knew this was coming, but now that it's official, the question is, what happens next? Let's start with the immediate impact. For anyone on a variable rate mortgage, you're going to feel this right away. The prime rate, which is what lenders use to set variable mortgage rates and lines of credit, just drops from 4.95% to 4.7%. On paper, that might not sound like a huge difference, but let me break it down for you. For every $100,000 on your mortgage, this cut saves you about $12 to $13 a month on a standard 25-year amortization. So if you're carrying a $500,000 mortgage, your savings is roughly $65 a month. That's money back in your pocket. And after the last couple of years of higher payments, even a small amount of relief feels like a big deal. Now let's contrast that with fixed rates. Fixed rates don't move directly with the Bank of Canada. They're tied to the bond market, and bond yields, which drive fixed rates, had already come down earlier this month. That means lenders had already started to bake this cut into fixed rate pricing. So don't expect big changes on the fixed side immediately. You might see some lenders shave 5 to 10 basis points off of the rate, but that's about it for now. So if you're variable, this is an instant win. If you're fixed, the impact could be more muted. And what really matters is where bond yields go from here. Now let's talk forecast, because this is where it gets interesting. Some groups are extremely optimistic. For example, CAD-TOD, which puts out some pretty bold outlooks. They're saying that the 5-year insured fixed rate mortgages, which are sitting around 3.8 to 3.9% range today, could drift down into the low 3s by next year, and maybe into the 2s by 2026. That's a huge call. If they're right, it could mean an enormous amount of relief for home buyers and for people renewing their mortgages in the next year or two. On the other side, we've got the big banks: RBC, TD, CIBC, BMO, and National Bank. Most of them are a lot more cautious. RBC is basically saying that's it. don't expect any more cuts. TD and CIBC are leaving the door open to maybe 1 or 2 small trims going into 2026. And BMO and National Bank are a bit more generous. They see more cuts ahead, but spread out slowly over time. Then there are the independent forecasters, like Mortgage Sandbox, who try to take a middle ground view. They're calling a 5-year fixed rates to land somewhere around 4.2% by the end of this year, and variable rates closer to 4%. Not quite the dream scenario of 2s and 3s, but definitely lower than where we've been. So why are these outlooks so different? It comes down to 3 big levers: inflation, jobs, and global policy. Let's start with inflation. Yes, it's come down a lot from its peak, but core inflation is still hovering around 3%. That's above the Bank of Canada's comfort zone. They want it closer to 2%, and until they're confident it's moving there consistently, they're not going to slash rates aggressively. Next is jobs. We've talked about this huge miss in August, losing 65,000 jobs when the forecast was for growth. That's not just a blip, it's a warning sign. If the job market keeps weakening, that's going to put more pressure on the bank to support the economy. And then there's global policy, specifically the US Federal Reserve. Right now, the Fed's rate is still above 3.75%, and they've been slower to cut because inflation is cooling more gradually in the US than in Canada. If Canada cuts too aggressively ahead of the US, the Canadian dollar weakens. Imports get more expensive, and that could reignite inflation here at home. So the Bank of Canada has to balance domestic conditions with what's happening globally. So let's bring this down to the household level with a quick case study. Imagine a family with a $600,000 mortgage on a 25-year amortization. Yesterday, with prime at 4.95%, their variable payment was $3,320 a month. Today, after the cut, that payment is closer to $3,255. That's a savings of $65 a month. If the bank cuts again by the end of the year, their savings could double around $130 a month. That's like getting 1 free hydro bill every single month. But if today's cut is the only one, then those savings plateau. So while this cut is relief, the bigger story is what comes next. For fixed rate borrowers, the story is different. Lenders might trim a little off of the posted rates, but the big moves only are going to happen if bond yields keep falling. And bond yields are influenced not just by Canadian data, but also by global markets, especially in the US and Europe. Speaking of which, let's quickly zoom out. In the US, the Federal Reserve hasn't cut rates yet. They're being much more cautious because inflation there is proving to be stickier. In Europe, the ECB is also on edge about wage growth and energy prices. So Canada cutting first is a bit of a gamble. It shows that our economy is in a different place, but it also risks pushing down the Canadian dollar, which makes everything we import, from food to gas, more expensive. This is why today's decision is such a balancing act. On one hand, households need relief. People are stretched thin. On the other hand, the bank can't risk cutting too quickly and letting inflation flare back up. So where does this leave you? If you're in a variable rate, you're getting immediate savings. But don't just take that $65 and spend it. My advice, keep your payments where they were before the cut. Use the savings to build a buffer. That way you're paying down more principal, and you've got some breathing room if rates stay higher for longer than expected. If you're in a fixed rate, patience is key. Keep an eye on the bond yields. If they keep sliding, you'll see more meaningful drops in fixed rates. And if you're up for renewal soon, don't accept whatever the lender offers. Shop around. Compare the 3-year fixed against variable. With today's cuts, that gap has narrowed. And in some cases, a variable might actually make sense again. And for those who are really on the fence, consider a split mortgage. That's where you put part of your loan into a fixed rate and part into a variable. That gives you protection if rates go back up, but also the flexibility if they keep falling. The bottom line here is that today's cut is the first real sign that the Bank of Canada is willing to support growth again. But they're going to move slowly, and the path from here is anything but guaranteed. So after all this talk about charts, forecasts, economic data, let's bring it home. What does today's cut really mean for you? Because at the end of the day, that's what really matters. For variable rate mortgage holder, relief is finally here. It might not feel life-changing. $65 a month on a $500,000 mortgage isn't going to make or break most households, but it's real. And more importantly, it signals that we may be finally turning the corner after years of higher payment. If you've been hanging on, waiting for some sign of relief, this is it. For fixed rate borrowers, the story is different. Today's cut doesn't change much immediately. Fixed rates are driven by bond yields, and those move based on a whole set of global factors. But what this cut does do is set the tone. It tells bond markets that the Bank of Canada is back in easing mode. That creates momentum, and if bond yields keep drifting down, fixed rates will follow. It might not be tomorrow, but it's coming. And the economy as a whole, today's move is a clear signal. The bank is willing to support growth again, but they're still cautious. They're not slamming the gas pedal, they're tapping it gently. They're watching inflation like a hawk, and they're watching the job market to see how much more help it really needs. So what should you do with this information? Let's walk through a simple 5-step action plan. Step 1, if you're in a variable, don't lower your payment. Yes, you're saving a little bit each month now, but instead of spending that money, keep your payment where it was at before the cut. That extra amount goes straight towards the principal, building a buffer for you and getting you out of debt faster. Think of it as a future-proofing your mortgage. Step number 2, if you're in a fix, start shopping early. Don't wait until the last minute to renew. Some lenders may trim rates slightly in the coming weeks, but the real opportunity will come if bond yields keep sliding. By starting the process early, you put yourself in a position to lock in the best deal at the right time, instead of being stuck with whatever the bank is offering you at renewal. Step number 3, if you're renewing soon, compare terms. The gap between 3-year fixed and variable rates has narrowed a lot. That means the decision is less about what's cheapest today and more about what fits your risk tolerance and goals. Do you want certainty? Do you want flexibility to take advantage of more cuts down the road? This is where personalized strategy makes all the difference. Step number 4, consider a split mortgage. A lot of people don't even realize that this is an option, but one of my favorite strategies in a time like this, put part of your mortgage in a fixed rate and part of it in a variable. That way you've got protection. If rates don't fall as quickly as you'd like, you can also benefit if they keep dropping. It's the best of both world approach, and for a lot of families, it brings peace of mind. And step number 5 is pay attention to the next data points. The October inflation report and the October 29th Bank of Canada meeting are going to be 2 big ones. If inflation cools further and the job market stays weak, there's a good chance that we'll see another cut by the end of the year. That's when the saving really starts to add up. So mark those dates in your calendar because they could set the tone for your mortgage strategy heading into 2026. Now, I want to leave you with this thought. Yes, today's cuts is a step in the right direction. Yes, it's a bit of relief, but the bigger story isn't just this 1/4 point move. It's about what comes next. It's about being proactive instead of reactive. It's about making sure that you're not sitting back, hoping that rates go down, but actually putting a plan in place so that when the opportunity comes, you're ready to act. Because here's the truth. In every rate cycle, there are winners and there are losers. The winners are the people who are prepared, who shop around, who ask questions, and who build a strategy that works for their family. The losers are the people who wait, who assume that their bank will take care of them, and who don't make adjustments until it's too late. And I don't want you to be in the second group. So if you're watching this right now, take today's rate cuts as a signal. Review your mortgage, look at your budget. Talk to a professional. Figure out if you're in the best position possible, or if there are changes that you can make to free up cash flow, pay down debt, or protect yourself from what's still a very uncertain market. Because the bottom line is simple. Today's cuts gives us a taste of relief, but the bigger story is still being written. And the question is, are you going to be ready when the next chapter begins? If you found this helpful, please hit the subscribe button. It's the easiest way to stay on top of these updates. And if you want personalized plan on your mortgage, tailored to your numbers, your goals, and your situation, I've left a link in the description where you can book a one-on-one call with me. Let's make sure you're not leaving money on the table.